All right, welcome everyone. Happy Thursday. Thank God it's almost Friday. Welcome to the Wealth Management Show. I'm your host, John Paul. Through this stream, you'll be able to leverage expertise of various experts in financial services and specifically within wealth management and related fields to elevate your knowledge, make you smarter investors, make you help you better manage your own wealth and make better decisions, whether you're a do-it-yourselfer or a consumer of advice and wealth management advice. So glad you're here, and this is the first step in advancing your knowledge and doing exactly what I just mentioned, becoming a better consumer DIYer. So welcome and good on you for being here and elevating your knowledge. So today's stream is going to build a little bit on what we talked about last stream, which was one of the key findings related to Vanguard's Advisor Alpha study, which talked about what are the specific functions a financial professional can execute to lead to the biggest benefit. And what we found and what I discussed with you guys is it's not necessarily what you would think, not necessarily things like how the investments are distributed or the specific funds and what are the costs of them or the management of the investments and rebalancing, that sort of thing. The number one most important item was behavioral coaching. And we delved into what does that mean? How do you know if you're receiving it? So if you haven't checked it out, please look at our last stream. Go onto the YouTube link if you're not already watching on YouTube. And all of the replays are there. So you can check it out. It was the last live stream on Tuesday. So the way that we're going to build on that last one for today is we're going to discuss some specific behavioral biases as our topic of the day. And before we get into that, just a little bit of background on me. I'm one of the co-owners of an investments firm named Rushlight Investments, and I'm the private wealth manager at the firm. And my goal and my job is to keep clients' large goals, the 30,000-foot view on their big goals of retirement, lifestyle, philanthropy, all these sorts of things, the next generation and their heirs, how this is going to be handled. That's my job, to make sure that portfolios, legal professionals, your CPA, everything is working cohesively, seamlessly, in a synergistic way for those goals. So you know a bit of my background. That's what these topics that I talk to you about all relate to. So in the spirit of our last stream where we were talking about behavioral coaching being the most valuable thing that Vanguard found in their study for clients to be receiving, it was 1.5% a year on average over each year. So you have to understand that compounds over time. So we hyper focus on that to make sure you understand it, make sure you're receiving it. Now the next step is let's talk about some behavioral biases, because if you understand what those are, you're much better equipped to deal with them. So let me put something on the screen for you guys very quickly, because I have a question. And take your time, no rush on this. But I have a problem here on the screen. You have two decisions to make. Decision one, you have the option of a guaranteed $7,000 gain. And then B is a probability. It's not guaranteed. You have an 80% chance of $10,000 gain or a 20% chance of gaining nothing at all. So I wanted to ask you, just think about this for a second. What would you pick? There sort of is a right answer, but it's more complicated than that. We'll get into that. So don't be scared. Just choose what you really believe, what you really feel. Those are your two options: the guaranteed 7,000 or an 80% chance of a little bit more, so 10,000, or but also a 20% chance of zero, which is obviously less than the 7,000. So what sort of entices you? You just type A or B in the comments or in the chat. And then the second decision you need to make is, and you have to choose one of these. I know it deals with a loss, but you have to choose, okay? There's an option C of a guaranteed $7,000 loss, or the other option, which is D, 80% chance that you have a $10,000 loss, which is higher than the guaranteed 7,000, but then you have a 20% chance of not losing anything at all. So that's your choice. A probability versus a guarantee is the case in both of these scenarios. And I really want to know what you guys will choose. So just type in chat at any point. You could keep thinking about this as we go on. And what exactly would you choose? Is it, you could say A, C, B, D, whatever that combination is. And try to come up with a reason in your mind so that we could later, if anything, we could challenge it, or we could delve into why did you pick the items that you picked. And when we go into our topic at the end of the show, we'll cover the news very briefly and the markets very briefly, and then we'll delve into this problem as it relates to biases. So yeah, I'm really interested to see what you guys think. And if you're embarrassed, you don't have to type it in chat. You could just make a mental note as well, though. I won't hold it against you. We're going to cover the answers regardless, so stick around. And anybody watching on Facebook, I've provided our channel link in the description. The stream tends to be a little bit more reliable on YouTube, so if you're having any issues and it's buffering with the small circle, come on over to YouTube, give us a subscribe so you don't miss anything. We're going to keep posting videos on there for your reference and so you could find them. And yeah, so with that being said, here's the problem. I'll leave it on for a minute longer and just chew on that. What would you choose? In each scenario, one is a gain, one is a loss, one is a guaranteed option, and the other is a probability. And this relates directly to the biases that we're going to cover today in the later part of the hour. So yeah, I'm excited to see what you guys think. So with that being said, let's move on to the news portion. And we're going to come over here to Bloomberg Markets. So it's a little pessimistic. I'm going to run through this one quickly, but it also relates to the topic I wanted to show you.
The newest round of coronavirus cases, that's where I want to start. It's causing a fresh round of challenges, especially you look at the surge in hospitalizations. Just give us a sense on the state of COVID in America right now.
Yeah, it really is ever-increasing, raising an ever-increasing clip in the final weeks of 2020. We are seeing, we saw on Tuesday more than 213,000 new cases, and that trajectory is beginning to show in fatalities. Whereas we didn't see so much of this in the fall, now in just more than a week of December, deaths were more than double the rate at the same week in November. So this is putting, a whole huge strain on the country, and the hospitals, as you note, are really, at the brink of not being able to take new cases because they're just full. In some areas of the country, we're just seeing a real crisis in being able to handle the number of cases that they're having. Infections in the South, in particular, composed almost a third of new cases, though 28 states broke single-day records in the past month.
Wow. Yeah, I hope you're staying safe. Do what you need to do to I know the fatigue of COVID and being locked up is absolutely brutal. I feel exactly the same way. I'm just walking outside more often to get some fresh air because it just feels like we're trapped all the time, and not being able to see family. My family and my wife's family have traditions of getting together all the time, and some of these things are being put on hold, and not just the COVID fatigue, it's kind of heartbreaking, to be honest with you. So that part is quite sad, but really it is serious, like people are dying, and I really hope, that you're taking care of yourselves. But to bring it back towards the topic of the day and the biases, if you've been frequenting the stream, you'll see that there's waves of positive news, waves of negative news. And if there's too much of a focus on any specific news, you're going to really be worried about the economy from one day to the next, or very optimistic from one day to the next. Let's say vaccine news comes out and it's positive. When that was happening, there was a really good response in the markets, as we saw. And then we've been seeing some more pessimistic news, maybe some allergic reactions going on and that sort of thing. And now it's pessimistic. And this is a very short time frame where emotions are being very swaying one way and swaying the other. And that sort of things opens you up towards behavioral biases, and the next step is, if those emotions overtake you, you're going to want to take action in your portfolio potentially, or you're going to want to make changes to what you're doing with your wealth. And that's avoiding some of those things and taking steps before issues happen is exactly behavioral coaching. I mentioned it last stream. The reason I'm constantly covering these stories and interpreting them for you live is because the way that I interpret them as an expert in these biases and behavioral coaching is, this is how you should be thinking about them, not just to appease your mind and not stress out, but to make better decisions and not be so swayed by headlines, and that could lead to poor decision making and specific biases that we'll cover today. So I had one more video here, and then we'll move on quickly because I really want to get to the topic of the day, which is the biases and that problem that I showed during the stream. So anybody hanging out, I'll flash it on the screen one more time before we move on after this video, and I really want some input on what you guys think about this problem. So where was this other video here that I wanted to show you? Oh yeah, this antitrust.
This is the biggest regulatory attack against Facebook in the company's history.
Absolutely, and the charges are strong. The suit says Facebook used acquisition to squash competition, and this comes on the heels of that October government antitrust suit against Alphabet's Google. Facebook was sued by U.S. antitrust officials and a coalition of states, and the legal goal is clear. The suit aims to break up the company by unwinding those acquisitions and focuses on Instagram and WhatsApp, as well as Facebook's alleged pattern of systematically eliminating competition in the U.S. that's known as illegal monopoly. Now, WhatsApp and Instagram are among Facebook's top acquisitions. If you look at the top two, you'll see that Facebook spent more than $25 billion for platforms that supported its private messaging. CEO Mark Zuckerberg has said that's where he believes the future is. Now, Facebook has been under the microscope for a while now, and the company, Facebook, saying they believe it's revisionist history to complain about Instagram and WhatsApp. They say those investments are why they're successful. Tom?
Yeah, so I think this is quite interesting because another great example. So Facebook, you hear about antitrust lawsuits. Some people might be investing in specifically Facebook, and this could be, what's going to be the impact, etc. So a lot of these stories can be framed negatively or positively, and you might want to make, let me trim, or let me buy Facebook, let me sell my Facebook, that sort of thing will drive you to think that, right? But what you should be doing in order to remove bias is look at the data. This isn't the first antitrust situation that we've had. Rely on R&D professionals like we have, and I rely on, to see what has happened before in the past. Try to make decisions on substantive data or probabilities. If we know how these things have played out in the past, we can derive a probability of what might happen this time in the future, and it won't be feelings based. And that's a much better approach to, digesting news that's coming out versus, they're going to break up Facebook. That's, like she just mentioned, Facebook's part of their case is that's why we've been successful. Well, if we start putting these things together, it starts painting a negative picture. And then, now I'm worried. Let me, in an emotionally driven decision, maybe trim my position, right? That seems like a natural thought process to go through, right? And that's the sort of bias that one of the biases that we'll cover specifically today. It's exactly that one. So I wanted to highlight that, and we'll actually move on. Let me put the problem up again one more time. So anybody who's hanging out, I'd love to ask you, there's two decisions you need to make, hypothetically. And the decision number one, you have an option for a guaranteed $7,000 gain. Or option B is you have an 80% chance to gain even more, which is $10,000, but that comes with a 20% chance to gain nothing. Okay? So you have a guarantee and then a probability. what would you decide? What are you leaning towards? What do you feel like is the right decision for you? And then decision 2 deals with a loss. Okay, you're in a position, let's say the real world example could be one of your positions has lost a little bit, and now you're choosing to hold on to it, which might lead to more loss, or choosing to hold on to it, it might recover and then there's no loss. So here it's a guaranteed $7,000 loss, option C, or option D, an 80% chance for an even greater loss of 10,000, with a 20% chance where you, let's say, recover and don't lose anything. What are you leaning towards? You could just say A, C, or B, D. Pick an option from decision 1 and pick an option from decision 2 and tell me what you think. And we'll cover sort of the where biases might come in here. This is sort of designed to trigger an emotional response on purpose and have your biases come up. So it's a bit of a trick question, but don't be scared to answer it, because understand that there isn't really a right answer. Next week, our next stream on Tuesday, we're gonna have our portfolio manager come in and sort of dig into why the reality of some of these questions are more complicated than they seem. What your own preferences are very important. What there's something called risk tolerance or loss aversion that is different from person to person, and depending on how you feel about some of these things, Dick might change the answer for you, even though there's a mathematical result, or there's a mathematical answer to both of these. So yeah, here it is again, just so you guys could check it out, chew on this question. What would you choose here? What are you biased towards choosing? Is it A or B for decision 1? Is it C or D for decision 2? All right. So with that being said, we're going to just do the quick market watch now, and we're going to go on. Let's take a look at the markets. I'll switch my screen here so you guys could see the platform. For anyone wondering, by the way, this is a Thinkorswim platform. If anybody, they offer paper trading accounts as well. You could open up a free account and choose some of these. You'll have access to the platform. You can make trades with play money, and you'll have access to the entire platform. It's pretty cool. So here we have the S&P 500 on a heat map. It's slightly down today. We have gold is roughly flat. Over here on the top left, I have a watch list. That's what I'm reading right now. Gold, silver's up a little bit. Bonds are up for the day. Municipals and corporate grade. The world stock market on average tends to be up. It's represented by these two right here as a proxy. And then the main indexes that a lot of you might be familiar with, NQ here is NASDAQ. It's up just a tiny bit, of 0.15%. The S&P 500 is down just a little bit, also down, but 0.15%. The Russell 2000, which is this right here, this heat map here, smaller companies, is up for the day. Is sort of out of the common indexes, it's the one doing the best. So smaller firms within the stock market are doing a bit better. And something that's interesting always of the heat map that we take a look at is if some sort of narrative emerges from what we're seeing. We see over here energy is kind of like a highlight. Healthcare seems to be a bit of a highlight, where financials, industrials, maybe real estate, and utilities down here are some of the weaker points for the day. Yeah, that's pretty interesting. And if you've been following also these streams and you've been seeing the patterns over time, when there tends to be pessimism, you'll see maybe the S&P doesn't do as well as the NASDAQ. And then when there's optimism that things are opening back up, you'll see a bit of a flip in that. So, focusing a lot on the short term or any specific day, any specific week might lead you to buy into these short-term trends or really get behind some of these ideas that are happening right now. Like, oh man, tech's doing great. Let's hop on the tech train. Or, things are coming back. The Russell 2000, which is smaller companies, have gotten hammered. Let's hop on the Russell 2000 train. Where, I would urge you to not engage in that, because it directly ties into biases, which are also our topic of the day today. And yeah, just please do your best to refrain from that. And so today there hasn't been big news. The markets aren't moving so much, so it's kind of a not so interesting or exciting day. I think yeah, we'll go ahead and move on to the topic of the day. I'm excited to cover that actually. So let me switch screens here. So just for those of you, anybody who might be just joining right now, we're about to cover the topic of the day, which are behavioral biases. And the reason that we're covering behavioral biases is last stream, we discovered, or we shared with you guys the fact that what's called behavioral coaching is found by Vanguard to be the most impactful thing a financial professional can do for you. And if you're a do-it-yourselfer, it's the most impactful thing you could do for yourself. And I mentioned, funny enough, sometimes people ask me, why are you, a wealth manager, constantly studying biases and behavioral biases, and cognitive biases is another word for that. And it has to do with, to be an effective behavioral coach, you need to be very well aware of these things and very vigilant. So to build on the topic of last stream, today is kind of, let's start equipping you. Now we know that it's very valuable. We know that they found it to be a roughly 1.5% a year benefit to have or engage in behavioral coaching. So the next question is, how do we accomplish that? And the answer is, we start learning about biases. We try to identify them in our own life. And how do they come up? When are we committing biases? And start correcting them. Every time you correct them, it's a win. You know, investing, wealth management, these sorts of topics are long journeys, especially if you're still building your wealth, even if you're in retirement, but an early stage of retirement. We're talking 40 potential years ahead of you, 50 if you're younger. If you're still well into retirement, 20, 30 years is a very, very long time. And all of the decisions, good and bad, stack up and they start compounding. So what we want to do is put you in a position to compound, to learn about and compound good decisions, where a lot of people are compounding bad decisions, unfortunately, right? So I'm going to go ahead and, for the last time here, before we go into the biases, I'm going to put up the bias problem. So guys, please, I would love to hear what you think here. Decision 1, you have an option of a guaranteed $7,000 gain. The other option is a probability, where there's an 80% chance to gain even more, of $10,000, but then there's a 20% chance where you gain nothing, 0. So one's a certainty, one's a probability. And those are your two decisions for decision number 1. And then just think about that. Now decision number 2. There's a guaranteed $7,000 loss. And you have to pick one of these. I know they deal with losses. You have to pick one. They're separate decisions. And then the alternative is a 80% chance to have an even greater loss of $10,000, but it comes with a 20% chance to not lose anything at all. Okay? So which ones would you choose here? What does your gut feeling tell you? Does it tell you, oh, option A or option B? Does it tell you option C or option D? Because I think I'm going to give you guys a technical answer, but it's not very obvious. And next stream, we're going to delve into some of the nuances where, although there's a mathematical answer to these things, not everybody is going to have the same preferences. And sometimes a guaranteed loss might be too painful for certain people, where just even the probability of not having a loss, right, is worth taking. Some people will like to take these chances instead of the guarantees. And if certain pains or joys are going to outweigh the math for you, which totally, believe it or not, that is a valid concern some people have, the answer for you might be a little different. So yeah, I'm going to cover these biases right here. We're going to talk about them because they do relate to the answer. And then once we've done covering these biases right here, I'll review the technical answer to this question. So the first one I have here is confirmation bias. And what I wrote here is selectively processing information that supports your prior beliefs. And what that is as an example, let's take the election as an example. If you thought candidate A, just as a preconception, was going to be horrible for the economy, any news talking about how that candidate is going to be horrible for the economy, you'll hold on to. There is certainly always other experts and people saying the opposite side of that, where the candidate you don't want to win actually is going to be great for the economy. And what we do when we're scanning news headlines and when we're reading about things, we tend to hang on to and overly emphasize the things that already agree with an opinion we had. So when we're feeling certain inclinations, or we're having certain predictions about what's going on, and then we're doing research, we're reading headlines, we have to be very, very aware of what our preconceptions are, because it's a natural human tendency to hang on to the specific things that confirm exactly what you're thinking. And then when you do that over and over again, you're going to be so sure that your opinion is true that it might lead you to take massive action. And then when you ignore these other areas and the possibility of your opinion not being true, if it comes to bite you, it's going to be just completely dumbfounding. You're not even going to understand why it happened. It's going to be completely puzzling. I was so sure, I read research. I read billionaire hedge fund managers saying exactly what I was thinking, right? But the likelihood is that you might have ignored other experts, other billionaire hedge fund managers with maybe equally valid opinions saying the opposite. So going back to the topic of the day, which is the biases and why it's important for behavioral coaching, as you learn these things and you keep them front of mind, you won't become susceptible to. You'll be able to persevere over our human tendencies that lead to some of these biases. So another bias, hindsight bias, sometimes called the I knew it all along effect. So what happens here, a great example is somebody close to me was very concerned about the impact of the coronavirus on the economy. And I was explaining to him, especially in the early stages, that we had no idea how this virus was going to impact the economy. And that he was very pessimistic because he was reading a lot of pessimistic headlines. Probably confirmation bias played a role in what he was registering and what he was ignoring. But the early news wasn't so alarming, especially when we were first hearing about it. There was very limited cases. We were being told it was under control, all this stuff. It seemed odd to be so worried about it when there was a minimal amount of headlines saying that, right? And then when the subsequent economic damage happened, which now we know about, the hindsight bias came in full effect. And I knew it all along was very palpable in the conversations I was having with him. And the funny part is, now that enough time has passed, as there's been a second wave and there's been more lockdowns, the same conversation was had with them. And this person was telling me, look what happened. We're getting locked down again. The same thing's going to happen. And this was about a month or so ago. And I knew it last time. It's going to happen again. Trust me, etc. And I was explaining to him that, the situation's agile, right? There's now vaccines. It's always a difficult decision in the moment with the information at hand, because there's always positive news, there's always negative news, like we talked about in the confirmation bias example. So then when the stock market was actually recovering and going up from the point that he was so pessimistic, he's completely dumbfounded, because the hindsight bias was so still so recent and still so solid in his mind that he wanted to act on it, because last time he didn't do as much as he wanted to. So hindsight bias is also having selective memory and selective information, but about the past. We make very many predictions as time goes on, and we tend to only remember those predictions that were right, and we tend to ignore the predictions that were wrong. We don't even remember them at all. So one way to prevent hindsight bias is to really take into account all the times you were wrong. Try not to have too many preconceptions. And understand that there's professionals all over the world looking at these same issues and these same news and the same data and positioning accordingly. So it's very hard to take advantage of things unless you really, really do have real insight, real knowledge, not just, an opinion or a hunch driven by bias. So please keep that in mind. And understand this is just 4 biases for illustrative purposes. I have here the Wikipedia list of cognitive biases. I just chose 4 to talk about today that I thought were relevant. But look at the sheer size of this list. Okay, there's so many biases, and they stack on top of each other. When a few of them come together in one scenario, it manifests, and you're so sure of something that you would almost stake your life on it. But the reality might be that you don't know, and there's just several biases stacking on top of each other, leading you to be just so confident that you can't even, sometimes you can't even deal. So to wrap up, then, loss aversion. This is well studied that the pain that people experience from losing is typically greater than the joy or satisfaction of gaining. And that leads to something called loss aversion bias. And what happens is in scenarios where, this is highly related to why people sell at near the bottom of markets and then buy maybe later on near the top. And it has to do with if they've already sustained a loss, the thought of even more losses is so much more painful than the joy of recovering that they may not want to participate at all. And that might be completely detached from logic, but loss aversion bias could just be there, just nagging at them, tugging at them very in a huge way. And that's the unfortunate side that leads people to, sometimes sell at bottoms, as we all know is very common for people to do. And then the last one that I wanted to cover today is neglect of probability. So this deals with disregarding probability when deciding under uncertainty. So you know how earlier in the hour we talked, there was the headline about the Facebook, and I explained how, instead of just having a pessimistic or an optimistic view, you could take the idea of how has this played out in the past? How has the probabilities played out when we crunch all the antitrust issues that have been resolved over the time, all the companies that have been broken up by the government? What happened in the subsequent years, in the subsequent months to those companies? Is there similarities to what's happening here with Facebook? If you look at it in a more quantitative way, you rely on history, you're kind of taking into account probabilities. But a lot of times people will neglect the probability. They'll just think, this is a negative thing or this is a positive thing, and they'll just go, they'll kind of run with that. So there's oftentimes some probabilities we could garner from different situations. That's why you need sophisticated research and development to help interpret news and tell you about the history, tell you about the data, explain to you what's happened in the past, right? And that will prevent you from neglecting probabilities because you'll at least be aware of them, be aware of the probabilities. So in summary, these are just 4. Like I said, there is a exhaustive list of biases. And I think these things are fun because I think to myself all the times in my life, I've had so many years of programming, almost a full decade of specifically managing wealth with high net worths, where it's nonstop dealing with biases, trying to overcome them, where it gets a lot easier, but the power of them is so great, you still are constantly dealing with them. And I love thinking back on like, well, yeah, I was using confirmation bias in the past, or I was using hindsight bias, loss aversion, etc. Because those are the things that you could do to prevent you from doing them in the future or recommitting these crimes against your portfolio again and again. So that being said, last chance to think of your answer to these problems, because we're about to cover the math behind this, and we're about to cover the reasoning behind these options. So here are the 2 decisions. One is a gain, one is a loss scenario. Decision 1 and decision 2. In both scenarios, you have a guaranteed option, and then you have a probability that you could take on. So as you see there, guaranteed $7,000 gain, 80% chance for a 10,000 or 20% chance for a 0% gain. And then you have the opposite scenario in decision 2, but dealing with losses. So let's see now. Let's see if you guys were correct. Let's see who's 2 for 2, okay? And before I show the answer, understand next week we're gonna have our portfolio manager come in on Tuesday, so stick around for that. We're gonna delve into some of the nuances, and we're gonna give a way more practical example on something like this, because this is a simple illustration. Some people could say it's oversimple, but here we're gonna go into the answers. So the answers are B and C, and I'll explain to you why. So in scenario 1, the guaranteed 7,000 is sometimes highly appealing to people because, in the option B, you have the chance of not gaining anything. And, sort of the bird in the hand, 2 in the bush comes to mind, right? Where I have that 7,000 in my hand, where the 10,000 is the 2 birds in the bush, right? But when we take into account the probabilities, the expectation of option B is $8,000. That's how the math works out. And you can see the math right here. The 10,000 times, should be times 80%. And then it gives you an expectation of $8,000, right? And the issue here is people tend to focus overly on what do I feel, right? If I really subscribe to the 1 bird in the hand versus the 2 in the bush, I might pick option A, but I'd be neglecting probabilities and exhibiting a bias in that scenario because option B has a higher expectation of a result, okay? It has a higher expectation of a gain. And what this also speaks to decisions being part of a journey. So if you take option B and it doesn't work out, that doesn't mean you didn't make the right decision, right? That would be you taking into account hindsight bias way too much. If you chose option B and it's the statistically correct decision, you should have confidence that in the future you're going to keep making statistically correct decisions over and over and over again, and that's going to lead to a benefit over your life versus taking suboptimal decisions that make you feel better over and over again. Then hindsight bias comes up, that sort of. Then in decision 2, a lot of people refrain from picking a guaranteed loss, okay? And the reason is nobody likes taking a guaranteed loss. It seems horrible. At least in option D, I have a 20% chance of not losing anything, right? But if you do the math again, the option D has an expectation of an $8,000 loss. The way that a financier would look at it, the expected loss of option D is 8,000. And that's a higher loss than option C, which is 7,000. So from a purely just statistical perspective, you would take that guaranteed loss, which for a lot of people, even after hearing the answer, it seems unacceptable. It seems no way. I actually do not want to take the guaranteed loss. 10,000, you might be thinking things like 10,000 isn't that much more of a loss. I already have a guaranteed $7,000 loss. And at least here I have an option or a chance at only losing nothing. And that would be statistically wrong. And if you were to choose option D and then ended up with the $10,000 loss, which is more likely than the 0, you have neglected probabilities. You might think, oh, in this scenario, the hindsight bias would prove you right. You'd be like, oh, I should have taken the guaranteed 7,000. And in this scenario, you'd be right, where in the top scenario, you'd be wrong. So the reason I wanted to cover this problem is because it's very simple, and typically people will have a gut reaction to what they'll pick, A or B, and then C or D. Right away, they can give you an answer. But when you look at the probabilities of it, it tends to flip it on its head, where, option B, where you could possibly gain nothing, is actually the correct answer. And then option C, where you take a guaranteed loss, is actually the right answer. And a lot of people think, guaranteed loss? No way, that sounds terrible. I don't want to take a guaranteed loss. So, this to me is a great little problem. I hope it got you guys to think about some of these things. And it relates to some of the biases that I talked about, where you might be neglecting probability in decision making. You might have had a very strong inclination as to what was the right answer in these two decisions. And if you neglect probability, you'll come up with an answer snap of a finger. But if you do the math, you'll see that option B, where you could gain nothing, is actually a better option statistically. And then you'll see here a guaranteed loss is actually a better option than rolling the dice here for a higher loss or a chance of losing nothing. So I think that's very important. And then secondly, it's very easy, for example, in the first scenario, if you were to pick the statistically superior option, which might end up in you gaining 0 instead of a guaranteed 7,000, you'll look back and say, you know what, that was a horrible decision. I knew it all along. I should have listened to the old adage, one in the hand versus 2 in the bush. What am I doing? I absolutely, I knew it all along, but that would be wrong. So I hope this started, this was kind of thought-provoking for you guys, because there's many biases that are going to attack you. You're going to be under siege constantly in managing your wealth, in life in general, but specifically when it comes to investments. Bad decisions lead to losses in dollars that are right in front of you, very hard to ignore. Sometimes it can be very, very painful, right? So the biases are just literally, your mind is under siege, and we're programmed in a way to exhibit confirmation, hindsight, loss aversion, neglect probability, all of these biases. So I'm glad you guys are participating in this, because like I said, this is the first step in committing less of these biases. The more familiar you are with them, the more times you ask these sorts of thought-provoking questions like this decision here, you'll be able to better arm yourself for the future when they arise again. You could think, hey, this is just like the bias problem that we covered on stream, where it didn't seem like I might be making the right decision, but when I took into account the probabilities, when I took into account what's the statistically best route, that was the right decision, or I am making the right decision. And then just have a little bit of faith that good decision making, even though there's a probability it doesn't work out, doesn't mean that you were wrong, doesn't mean that you made the wrong decision. If there's something that's going to be a great thing for your life, but there's only a 60-70% chance it works out, there's a good chance it doesn't work out. But does that mean you shouldn't participate? I think not. And the in that long journey of managing your wealth, there's going to be all these biases, and what you really need to hyper focus on is just making the best decisions possible, from a statistical perspective, from a integrated wealth management perspective, and the like. So that basically wraps up the lesson for today in terms of the topic of behavioral biases. And again, I urge you guys, hop onto our YouTube channel. We're going to be doing more of these videos on Tuesdays and Thursdays. We stream at noon Eastern, and we always have a topic of the day. Typically, it builds on previous things that we've covered before. So make sure you subscribe, because the library of videos is being built on YouTube. So it's very easy to find what you're looking for and go back to update yourself on a previous stream, etc. So I'll see you back next week on Tuesday. Like I said, we're going to delve into this issue a little bit deeper with our portfolio manager and take into account things like utility. What does that mean, and how does that influence these sorts of decisions? What is loss aversion, and how does that sort of vary from person to person, and what's a more real life example for you guys? But sort of as a primer, I wanted to cover some biases just to start. I'll put them again on screen, some of the ones that we covered here today, and pose a simple, oversimplified, some may say, idea and problem that exhibits some of these biases. And we're going to keep working on this stuff, because biases, I'm going to keep, I called this video Behavioral Biases Part 1, because we're going to keep covering these things. we indirectly cover them through the news and how I help you guys interpret what's going on and think of it how a wealth manager would versus how just, your mind might take you in a certain direction. So I hope to see you guys again. We'll be back on Tuesday. Again, please subscribe and to our new YouTube channel. We just created it just a week ago. We're going to keep posting on there live streams and video replays and highlights. Next week, like I said, we have our portfolio manager coming in, and we're likely going to have a CPA coming in talking about the tax impacts, potential tax impacts of Biden administration with a potential Senate majority, depending on, I know we have some pending runoffs, the Georgia election for the Senate seats, that sort of thing. So what's going on with that, the CPA and tax planning perspective on that, you're going to get an insight to how does a wealth manager like myself speak about these topics and plan ahead of time with a CPA that's specialized in the area. We're going to have those conversations live for you guys so you guys could get insight and see how that works, what could be done, what's on their minds, and what are the risks versus benefits of being proactive relating to something like that. So great to see you guys. Again, anybody new that stopped by today, welcome. I'm glad to see you. We'll be back again next week, and I'll throw up some contact information for anybody that wants to reach out with stream feedback or for any business purposes. There's a specific email for that. And have a great weekend. Thank God it's almost Friday, and we'll see you again soon.